Okay, we've prepared the financial statements. So now we'll start with closing entries. Closing entries are journalized and posted to the ledger. You guys, there are two purposes in making closing journal entries. The first purpose is they prepare temporary accounts for use in the new accounting period. And you can find this file, Steps in the Closing Process, available on your Moodle site. The temporary accounts, or accounts whose balances begin each year with a zero balance, are revenues, expenses, and dividends. Now, they report amounts for the current period only, or for the current fiscal year only, so they have to begin each new year with a zero balance. The closing entries accomplish that purpose. Also, the closing entries transfer the balances of these three accounts into an account that does carry forward year to year, retained earnings. Okay, and here are the 4 steps in making those closing entries. And we'll go through them one by one. Okay, number 1 says debit each revenue account for the amount of its balance and credit income summary for total revenue. Okay, so we're going to debit each revenue account for the amount of its balance and credit income summary for total revenue. Well, let's look at why. Okay, so let's go to our template. With the first closing entry, we want to make all revenue account balances 0. Okay, so let's look for our revenue accounts. We only have one in this problem, and that's service revenue. And notice it has a credit balance for $160,000. So if we want to make that 0, we've got to debit service revenue for $160,000. Okay, so think about it. We've got a credit balance in the account for $160,000, a debit entry to service revenue for $160,000, credit balance and a debit entry we'd subtract, and that'll leave the service revenue account balance at 0. Okay, so we're going to debit service revenue for $160,000, the amount of its credit balance. Okay, and then the credit is to income summary. It's an account only used in the closing process. Okay, so we debited the revenue account for the amount of its balance and credited income summary for total revenues. You can also pick these up from the income statement. We credited service revenue for it, or debited service revenue for the amount of its balance, and credited income summary for total revenues. Or if you prefer, you guys, you can also go back up to the worksheet in your income statement columns and find the numbers here. Okay, let's continue on. With the second closing entry, we want to close out expense accounts. Well, notice they all have debit balances. If we want to make their balance 0, we'd have to credit each expense account for the amount of its balance. The debit side of that entry is again to income summary. So we're going to debit income summary for total expenses. Total expenses are $108,850 from the income statement. That'll be our debit to income summary. $108,850. Let's go to our rules. Number 2 says debit income summary for total expenses and credit each expense account for the amount of its balance. Okay, so that's what we're going to do. We've already debited income summary for total expenses. See, we picked up that number from here on the income statement. Now we're going to credit each expense account for the amount of its balance. So wages expense for $45,600. Then we'll credit supplies expense for $22,500. You see why? They have debit balances, you guys, and we want to zero them out, so we're going to have to credit them for the amount of their balance. Supplies expense has a debit balance for $22,500, so to make it zero, we're going to have to credit supplies expense for $22,500. Okay, the next one. Rent expense has a debit balance of $10,600. We want to make it zero. We'll credit it for $10,600. Okay, then we have truck expense, a debit balance for $9,000. So we'll credit it to make it zero. See, when these get posted, when this gets posted to service revenue, which we'll do when we finish the entries, it'll make service revenue zero. When these get posted, it'll make our expense account balances zero. Okay, so what's next? After truck expense, we've got depreciation expense on equipment, debit balance for $83.50. So we'll credit it for $83.50 to zero it out. Next, we got depreciation expense on trucks. It's debit balance for $6,200. So we're going to credit it for $6,200 to zero it out. Then we've got insurance expense, a debit balance for $1,800. We'll have to credit it to zero it out. And then finally we've got miscellaneous expense. Has a debit balance for $4,800. To zero it out, we'll have to credit it for $4,800. This part can be a little bit awkward, you guys, but I think you'll notice, or you'll see when we post these, how the revenue and expense account balances end up at zero after these journal entries are posted. Okay, so what did we do with the second closing entry? Let's look at it again. We debited income summary for total expenses, and we credited each expense account for the amount of its balance. Okay, with the third closing entry, we want to close out income summary. Let's look at it. Income summary is only used in the closing process. And in the closing process, it has been credited for $160 and debited for $108,850. So if we want to know the balance in the account, we need to subtract. Well, the balance in income summary is going to be a credit balance when we subtract, because $160,000 is greater than $108,850. So we're going to end up with a credit balance for the difference. So if we want to make income summary zero, we'd have to debit it for the difference in these two entries. So we're going to debit income summary here for the difference in the credit and the debit, which would be the balance in the account. Okay, so it's going to be equal to the $160,000 credit minus the $108,850 debit. By debiting the account for the difference in the two entries, we're able to zero its balance out. And that's $51.50. Now, you've seen that number before. That number should always be equal to net income, because what's this number? Total revenues. This number is total expenses. So the balance in income summary should be equal to net income, and it's going to be a credit balance. To make it zero, it has to be debited. Let's look up here. See, your net income, $51,150. We had a credit balance in income summary for 51,150. 160 minus the 108,850. If we want to make that credit balance 0, then we have to debit the account for the amount of its balance. Okay, now the account to credit is the account that gets increased at the end of the year by net income for the year. Well, let's look back. Retained earnings was increased by the amount of net income for the year. Remember, retained earnings increases on the credit side. So two purposes here. We're making income summary 0 by debiting it for the amount of its balance. And we're going to increase retained earnings for the same amount, 5150, which was net income for the year. So that makes income summaries, the debit makes income summary 0, and the credit to retained earnings increases its balance by the amount of net income for the year. Okay, so let's read that one. Here's what we just did. We debited income summary for the amount of its balance, which should be equal to net income. And we credited the retained earnings account. Let's add in for the same amount, or you can add that in if you'd like. Of course, it would be the same amount if those are the only two accounts affected by the entry. Note that the accounts debited and credited are reversed if there's a net loss. Okay, with the last closing entry, we want to close out the dividends account. So let's go back and let's find the dividends account. Dividends has a debit balance for $15,000. If we want to make it 0, then we'd have to credit dividends for $15,000. Okay, now what are we going to debit? Well, it's the account that gets decreased by dividends at the end of the year. Let's look back up here. Retained earnings gets decreased by dividends at the end of the year. The retained earnings account decreases on the credit side. So two purposes for this entry as well. The debit to retained earnings reduces its balance by the amount of dividends declared for the year. And the credit to the dividends account zeroes it out for use in the new year. So let's go back through these. The first entry, we close out revenues to income summary. With the second entry, we close out expenses to income summary. With the third entry, we close out income summary to retained earnings. And with the fourth entry, we close out dividends to retained earnings. Now, let's look back at our chart or our Excel file. Accounts whose balances begin each year with a 0 balance are revenues, expenses, and dividends. Those are the ones that we zeroed out. Assets, contra assets, liabilities, capital stock, and retained earnings will carry forward year to year. And you'll notice that they still have a balance after we post these closing entries. You guys will post the closing entries from here in the next video. Thanks.